Hello everyone. In this video, we will cover disadvantages of preference share and suitability of preference share for the company and difference between equity share and preference share. So, disadvantages. First disadvantage is that is costly source. When you compare equity share with the preference share, you will find that issuing expenses of preference share is costly as compared to the equity share. And when we give dividend to equity and preference shareholder, so preference shareholder dividend is not deductible for tax purpose. So that's why preference share is a costly source for the company. Next one, it is a permanent burden. Permanent burden, it means, as we know that in case of equity share, at last equity shareholder will get the profit. If profit remain or residual profit will be there, then equity shareholder will get dividend. But in case of when we talk about dividend on preference share, it is considered as a permanent burden, because if company don't have profit to give as a dividend, then in case of cumulative preference share, company have to pay that dividend to the next year. So that is considered as a permanent burden. Next, legal formalities. When we compare preference share with the equity share, we will find that more legal formalities required for issuing of preference share. So many formalities are there, and that is a hectic process for issuing the preference shares. Low appeal. It means that when we issue equity shares, so obviously the investor who are adventurous or who like to take risk, they will like to invest in the equity shareholder. The person who is not is not taking risk, the person who is not taking risk and conservative investor will like to invest in debenture. So very few people will like to invest in the preference shares. So it is very few people will like to invest in the preference shares. So that is a low appealing securities for the investors. Now when we talk about disadvantages from the point of view of shareholder, these above point related to the viewpoint of company. Now these points are related to the viewpoint of shareholder. So first one is the lack of voting rights. As we already know that equity shareholder have voting right, but preference shareholder don't have voting rights. In limited cases they have voting rights, like if any decision that is against the preference shareholder cases, in that case they can take objection, like participating preference share can take objection regarding that. But in other cases they don't have any voting rights, and whatever decision that will be taken by the equity shareholders. Now, fear of being shown the door. It means whenever like equity shareholder are the first owner, and share generally issued firstly to the equity shareholder, and they are the real owner of the company. So whenever company required, it means whenever company required money in urgency, or they don't have any other option, it means they already raised from the equity shares and debenture, so they will prefer to take money from the preference shareholder. But when their needs completed, they can redeem preference shares. So when company did not require their capital, or company have excess amount, so company can return their amount. So that is the fear of being shown the door. It means whenever company did not require their capital, company can repay or redeem the share, and that is the another fear for the preference shareholder. No capital appreciation. As we already know that equity shareholders have capital appreciation, because that is tradable securities, and whenever profit of company is good, so obviously share price of company will share price of equity share will increase, and that benefit will be taken by the equity shareholder. But in case of preference shareholder, they have the limited it means a fixed rate of dividend is there. so they won't get a capital appreciation. And in year of prosperity, whenever company make good profit, all the benefit will taken by the equity shareholder. They have very less chance to get profit, except participating preference share. No guarantee of dividends, as we know that preference shareholder also consider as a shareholder of the company. In case if company is not getting profit, so there will be no dividend. It is, as we already know, that is hybrid security, so feature of debenture and feature of share both include in that. But if profit will be there, then they will get the dividend. If profit is not there, they won't get their dividend. Now, although there are many disadvantages related to preference share, but sometimes that security is suitable in some cases for the company. First, when the assets are not acceptable as sufficient collateral security for issuing debenture. So here some condition that is mentioned, like company don't have that much sufficient collateral security, company don't have that much assets on the basis of that they can get the loan. So in that case, it is always beneficial for the company to issue preference share, because they will get the money without mortgage their assets. Second, when higher interest will have to be paid by issuing debenture against assets which are already mortgaged. When higher interest will have to be paid, it means you are paying higher interest on the issuing debenture, and you already it means already you have mortgage your assets against the debenture, and you are paying higher interest against the debenture. So it will be better to pay whatever amount you have taken from the debenture holder. You can return that amount by issuing the preference shareholder. So in that case, it is advisable to for the company to issue preference shares. When the company's promoters want to retain control without creating fixed obligation as to payment, like promoter or the first person who think to start the company. So when promoter think that control, it means control will be in the hand of the equity shareholder. So if promoter think that control will retain in the hand of the equity, so it is always advisable to issue the preference shares. Now last one is the when company need fund for medium term, it can issue redeemable preference shares. You already last year you read about the medium term. So when company required money for the medium term up to 5 years, so in that case company can issue preference share, because that is the medium term capital, and that will be suitable because fixed rate of dividend that you have to pay. So in that case, it is advisable to issue preference shares. Next one, distinction between equity share and preference shares. Already we have learn about equity share and preference share, but some difference that is easy to remember, like nominal value. When we issue preference share or equity share, so preference share value generally high price, and when we issue equity share, price of equity share generally low. Degree of risk, when we talk about preference share, degree of risk is higher in case of preference share, but when we issue equity share, so equity share involved high risk, as we already know that in case of winding up of company, preference shareholder will get their money return first, and after that if any amount remain, then equity shareholder will get their investment back. So that's why preference shareholder have comparatively low risk and equity share have high risk. Next one is the preference share. So right to dividend, prior to dividend on equity share, it means when company issue dividend or give dividend to the preference or equity shareholders, so first priority will get by the preference shareholder, and after that if any amount remain, then equity shareholder will get dividend. It means priority or privileges will given to the preference shareholder for paying the dividend, and if anything remain after that, then equity shareholder will get that dividend. Next, refund of capital. when we talk about in case of winding of the company, the same situation as in the case of dividend. So first priority of paying the dividend to the preference shareholder, and after that repayment after all other obligations are refunded. It means when you have paid, like when we talk about winding up of the company, first company will pay to the external liabilities, external creditors, bank, financial institution, after that preference shareholder, after at last if anything remain, then at last equity shareholder will get their money return. So that's why equity share is considered as a more risky. And voting rights, when we talk about voting rights, so preference share have limited voting rights, and that in some cases it is possible that if up to 2 or 3 years if dividend not paid, then preference share converted into equity share, so they will get the voting rights. So in that case limited voting rights is related only to the dividend if dividend remain unpaid. But when we talk about equity share, they have full voting rights, they have power to take decision, and nobody can take objection against their decision. So equity share have full voting right. In next video we will talk about bonus share or right share.